I mean, if you compare it, look at this magnitude of run up. It's really comparable to like over here, like a big run up like this. And look what happened for Bitcoin. I mean, Bitcoin went from 60,000 up to like 100,000, a $40,000 pump when you had an M2 pump this large. So that's the magnitude we're talking about here, guys. And it hasn't ended. It hasn't topped yet. We don't know. We don't know. Maybe it has topped. Maybe it will keep going. So that's why I'm saying, like, when we finally make it to this rally, this could be the rally that carries us to the blow off top. Hello guys, my name is Colin and this is Colin Talks Crypto. I wanted to bring you yet another video in the series of the global M2 money supply as it relates to and predicts the price movements, or seems to predict the price movements of Bitcoin. It has a correlative predictive relationship to Bitcoin that is actually mathematically calculatable. And that's exactly what we're going to show you in this episode. So I've got some pretty cool figures for you. This is some new stuff. And for a real quick recap, in case you're new to this chart and this correlation, because I do have a lot of new followers. So I'm going to give you a 2-minute overview of what this is all about. So this yellow line on these charts is the global M2 money supply. That is the aggregate of all nations on Earth, all the major nations on Earth, money supply, which is referred to as M2, totaled into one line. And this is what you can see here, okay, this yellow line. And the thing that's interesting about this is that it seems to act as a predictor of the directional move that Bitcoin and stocks are going to make. And you can actually calculate the mathematical accuracy of this, which is what we're going to do in this video. But basically, that's what this is. And I want to address one common misconception, because people see a chart like this, and I understand it's confusing. There's a lot of lines going on. And the first thought is like, well, wait, how do you have a line that goes into the future? You're just making this up? And the answer is no. This yellow line has been pushed forward, in this case by 70 days on this chart. On charts like this, it's pushed forward 105 days. And we'll get into what's the most accurate way to align these charts. And that's what this video is all about. But that's an explanation of how this is not the future data. This is the actual data that occurred on the global M2 money supply line, just pushed forward by 70 or 100 days or 46 days or whatever it may be. And then the question we are asking ourselves in this video is, well, which of those three options is the most accurate? And I do have an answer for you. Okay, so that's what this line is, and that's why it's useful, because we want to know what direction is Bitcoin and stocks going to move. And it's not 100% perfect, as you'll see, but in any odds-based situation, if you have, 80% odds of something happening, that's a bet that most of us will take every time, because mathematically, why wouldn't you? It's in your favor, right? And that's what we're looking at here. It's crazy. It seems like magic. It seems too good to be true. It's like saying that we can see the future of a price chart. And in a way, we kind of are, but it's not 100% guaranteed. It's only, 70 or 80% likely to happen. Okay. And my theory for why there's a delay of money entering the global monetary supply and then Bitcoin moving up later, which is the whole reason you can have this delay, pushing this chart forward is making up for that delay, is because it takes time for printed money by governments to find its way down to the hands of the people who then buy the risk assets. There's a delay because it's not instantaneous. And unfortunately, in fiat-based monetary systems, it's very unfair, because he who gets that printed money first benefits without the dilutionary effects, without it having inflated the money supply. If he's the first one to get that money, the government official who prints the money, he gets the full purchasing power of that money. But it trickles in through the economy. He buys some groceries, he buys some whatever he buys, prostitutes if he's a government official, who knows these days, right? And the money finds its way down to the regular people, and then they buy some stocks and they buy some whatever. And that's my explanation of why there's this delay. Okay, so that's the backdrop of what this chart is showing you and why the global M2 money supply seems to be all the rage lately if you're on X. So a user, Marnie Merrick on X, shared with me these three charts, and he created a script and he did the calculations for all three different most popular offsets. When I say offset, I mean how much that M2 line is pushed forward by, okay? So let's start with the 45-day shift. This is kind of where I started out, 45 or 46 days, give or take a day. It's not a big deal. And this was the one I had been using for a week or two until someone pointed out to me that probably the 70 or 75-day shift was more accurate. And I agreed with them and I said, you know what? I think you're right. I think I was wrong about that 45-day shift. I'm going to go to the 70-day shift or 75-day shift. But let's look at the numbers, because I didn't actually have the numbers for each of these different charts. And because of Marnie Merrick's work, give him a follow. He only has 80 followers and he did this amazing work. He created a script, and basically what it does on each of these three charts I'm going to show you is over the last X days, so over the last 30 days, over the last 60 days, over the last 90 days, meaning we're going back further on the chart each time on the correlation between these two lines. Are they moving in the same direction or are they not? And we want them to be moving in the same direction, which would give us the highest correlation figure over here. Okay, so you can see that on the 45-day shift chart, meaning the M2 line was pushed forward by 45 days, there's a correlation of negative 42%, which is really, really bad, of the last 30 days. So that would be from like here to here or something. Not much data, right? And you can see they diverge. They're not in sync. And so that does make sense. But let's go back a little further. Let's go back 60 days. And that would bring us back to here. Okay, well then you have sort of a flat period, a little bit of a flat period. There's a little bit of alignment, more than the 30 days. So you have actually a 30% correlation, which is actually still really poor, but at least it's not negative 42%, which is actually the worst on any of these charts, I think. Okay, and so as you increase the time span, you're going back further on the chart, calculating the correlation between these two lines, which has the benefit of giving you more data and a bigger sample size, which is great, but it has the con of the recency. You're losing the recency, you know? And as we've discovered, this shift does change over time slightly. It does seem that way to me. It does seem like it shifts and ebbs and flows. But we can also gauge that based on these charts as well. And you can see that the correlation does change as the period of time that we look at increases. So if you go back, for example, 720 days, which is basically 2 years, I think that is basically, yeah, that's the full chart being shown here. That is this full chart. It's saying that the 45-day shift has a 77% correlation. That's okay. That's okay. But look at this recently, like all the way through the last 180 days, it's been extremely not correlated, extremely not accurate. And only when you look at the 1 year or 2 year or 1.5 years time frame does it have really any kind of meaningful correlation. So I would say this is not a very good shift to use. A lot of people were telling me to go back to this shift. I just don't see it. I don't see it visually compared to the other charts, and I don't see it now numerically, mathematically backed up. It's not backed up visually. It's not backed up by the math. It's not backed up. 45-day shift, I think, is incorrect. You're free to use it. You know, I provided the script. I'll try to remember to put the link to the script in the description below in case you didn't see that in my last videos. But yeah, and I want to make a point that I'm not trying to dictate to you which is the correct answer. I can give you my opinion, and I'm going to tell you what I think, but I'm not telling you what is the correct answer because I don't know. I'm guessing too. I'm just looking at the data in front of me, and it's never 100% correct, right? And there could be something I'm not taking into account. I'm not a super genius, evil villain who knows everything. Trump could do something tomorrow that throws us all to hell. I have no idea. I'm just looking at the chart in front of me and making the best judgment that I know how. So I want to provide you with the information and see what you think. Okay, so this is my take. The 45-day shift is a weak correlation. A lot of negatives and really low percentage correlation in the last half year. Now let's move to the 75-day shift. Okay, that means that the yellow line has been pushed forward by an additional 30 days. Sort of like a 30-day echo, you'll see, because we are moving by 30 days on each of these charts, which makes some sense in the fact that a month has 30 days, and there's some kind of parallel to that, I think. But what do we see here? Well, we see visually, in my opinion, that it lines up much better. It lines up much better than the 45-day shift. You can see it's just way off here. It's way off down here. It's off in a lot of places. But the 75-day shift does seem to actually match the peaks and valleys a lot better. A lot better. So much better that I thought this is the answer. And let's look at the numbers, though. Like, the numbers are what tell us how accurate this is. Over the last 30 days of correlation, it's got a 61% correlation. Okay. I mean, that's a lot better than the 45-day shift's negative 42% correlation. Over the last 60 days on the 75-day shift, we have a 36% correlation. On the 90-day, we have a 37%. That's the worst, and that's not good. But the rest of them are all actually pretty good. You have a lot of 60, 70, 80% range. Again, the further back you go, the more correlated it seems. But if you step back and look at all these numbers, all these correlation figures, compared to the 45-day shift, it's hands down easy to see that the 75-day shift, I'm looking at them right now, actually performs better in every single time span. Every single one of these time spans has a stronger correlation than the 45-day shift. So for me, that's an open and shut case. Done, sign it off. 75-day is superior to 45-day. Okay. Now, what about this 105-day shift? Because I had a few people saying, Colin, hey, 75 is great and all, but look at 105 days. I'm like, okay, like everyone wants me to look at some different figure. Let me look at 105 days, okay? And lo and behold, while visually I didn't quite see that it matched as great as the 75, it's not as obvious to me, I guess. That may be just me. The numbers are very, very clear, okay? You can see I've drawn it here. You know what I'm going to say. The 105-day shift mathematically, irrefutably, has the strongest correlation of the three charts. Over the past 30 days, we have an 87% correlation. Over the last 60 days, we have a 75% correlation. Over the last 90 days, we have a 64% correlation. We have a 90% correlation half a year. For a full year, we have a 91% correlation. For a year and a half, 88%. These are insanely good numbers. These are insanely confident correlations. This is pretty crazy to me. Like, this is a very high range, much higher than even the 75-day shift. While I think that it is acceptable, it's okay. But in comparison with the 105-day shift, the 105-day shift wins hands down. And I can kind of see it when I'm looking at this visually. I go, okay, it kind of makes sense. So again, I step back, I lay my ego aside, and I look at what is the correct answer here. I'm going to have to go with the 105-day shift. I'm going to continue to look at both of these, though, because I do feel the 75-day shift looks good to me still, but the numbers are saying the 105-day shift is the most in sync or strongest correlation. All right. So I think purely analytically speaking, I should be looking at this chart. I mean, that's what the numbers are telling me, right? Be kind of foolish to ignore this chart. So now I took this chart and I put it into my regular charts, and I compared the 70 and the 105-day charts right here, so that you can see not only Bitcoin, but also stocks overlaid on top. We have the S&P 500 as this blue line, Bitcoin as this orange line, and the global M2 as this yellow line. And currently this chart is the 70-day chart that we said was just a mediocre correlation. Now, this chart, if this chart comes true, we have a little bit of sideways. We have like maybe a little bump up, fake out, but pretty much just sideways for another, I don't know, week and a half. And then a blast off date, supposedly around March 25th. That would be if this 70-day offset was the offset that is the most accurate. But we've just learned that it's not, okay? And I guess I feel a little bad because I'm not trying to like change the numbers constantly, but I would be more remiss in ignoring new data and ignoring more correct conclusions. So I put my ego aside and I say, well, let's look at what the numbers show us. The numbers just told us 105 days had the strongest correlation. And sure, if the 70-day correlation is holding true, I would absolutely love to see a blast off of March 25th. So let's say maybe if we get lucky, we'll see a blast off on March 25th. I don't think it's outside the realm of possibility, okay? Maybe it will. But the math is telling us that this is the most likely scenario. So what does it show us? Well, it shows us that where we're at right now is the beginning of a big sort of like You call it like a relief rally or a mini pump, but it fails. It doesn't sustain. It fails. So it looks like from approximately, I put the numbers here, approximately March 9th to, and we're already in March 13th right now, till about March 16th. That's this peak right here. You could maybe say we could extend it to March like 20th by this peak. We'll get a rally. And this will help us determine which chart we're looking at. Although, to be fair, this one also had a little mini rally, so it might be a little difficult to decipher which chart is causing the bump up. But if it's a fairly large rally, maybe it is because we're looking at the 105-day correlation. But unfortunately, this rally fails. And because this is a 105-day offset, we have even more time until this blast off line, this green line here. And so if the 105-day offset does prove to be the accurate offset, we are looking at a blast off date of approximately April 30th. So that's a little further away. That's a month and a half from now. Versus on the 70-day offset, we have just a week and a half or so. All of us watching this video right now want this outcome, and I do too. Like, my bias is on this chart, but I have to be careful because bias is a good way to miss the facts. And the facts are that this chart we just showed you has the strongest correlation right here. The 105-day shift has the strongest correlation. Go back and look at these other charts and these correlation figures, and you'll see that they are not as good as the 105-day shift. So if this is the outcome, let's say that this is the longest outcome, well, then we have to wait till April 30th approximately. Now, here's how I look at it. Whether we blast off on March 25th or we blast off on April 30th, as long as we just step back and go, you know what? This massive rally is going to happen either way. That's the glass half full. This epic amount of global liquidity is coming either way. It's just a matter of, it's a month difference, basically, just 30 days difference. And yes, things can bleed a lot in that time, but there is a little relief rally, a mini rally that might give us a little bit of relief at least. But I'm not convinced the lows are in until this rally is over, unless we do happen to be following the 70-day offset, in which case then we're almost ready for blast off, which I would love to see. And I hope that this is the outcome. I hope that the math is just odds, right? Like, there's a chance that this chart will still be correct. It's just because it's 80% chance that it's this chart doesn't mean that the 20% doesn't happen for this chart. So we can all have our fingers crossed. But I think we shouldn't be necessarily financially betting on this chart because the numbers are saying that this is the likely candidate. Okay, so the 105-day offset is the likeliest candidate, I should say. And either way, though, the glass half full is that this influx of global M2 capital is happening regardless of what chart we're looking at. It's still present. It's just a matter of when it's happening. And as I said in one of my other posts, this rally of M2 is so freaking large that even if the correlation doesn't quite follow perfectly, there's a point where there's so much capital being flooded into the system right here that even if you caught only half the rally, you're still going to get pumped. I just think it's unavoidable at this point. This rally has just kept going and going and going. It's gotten steeper recently. And it's not even over yet. There's no telling where this ends. What if it just keeps going? This could be the rally that leads us to the Bitcoin bull run top of this year of 2025. It could be. I don't know. And there's a lot of crazy stuff happening with tariffs and Trump trying to lower interest rates by like crashing the stock market temporarily and all this stuff. But I'm just looking at the chart in front of me. And the chart in front of me says that there's a massive global M2 liquidity injection. And Bitcoin is likely to be carried up with that, and stocks are likely to be carried up with that in 2 weeks or in a month and a half. But it's happening. And I think that this injection is so large that there's no choice but for risk assets to at least in part follow it. And I think in greater part, the longer this accelerates and keeps going. Okay, guys, so that's my takeaway. I'm very, very bullish about this. Yes, I know it's been painful, and I know that if we have to wait another month and a half, that is so, it kind of makes me sick to my stomach, to be honest. I mean, we've waited so long, but hey, I mean, there is this pump up. Like, we should see some kind of a bump up. We kind of have just yesterday. Bitcoin seems to kind of have bottomed out temporarily. It's bumped up. I'm just not convinced that that's the end of it. I think we might get a relief for, it looks like, I mean, how long is this? That's about, well, it's about a week or two up That's being generous. And about maybe 3 weeks down, and then sideways. And when things go sideways, it tends to bleed more. So we'll see where it ends up. But this is the moment of glory right here. This is the moment we have our eyes on. Yes, there can be pain in the interim, but you know what? Go find a hobby. Go do something else. Take your eyes off the chart. Stop torturing yourself. Do other stuff, because why look at all this when you know you're going to be up eventually, or you think you have high odds? We don't know anything for sure, but we have high odds of it. Okay, guys, so I want to leave you on that positive note. This global injection of liquidity is, in my opinion, purely thoroughly stated, going to have no choice but to pump the markets. The markets cannot ignore this. The markets, the stock market, Bitcoin, cryptocurrency cannot ignore this magnitude of a run-up. I mean, if you compare it, look at this magnitude of run-up. It's really comparable to like over here, like a big run-up like this. And look what happened for Bitcoin. I mean, Bitcoin went from 60,000 up to like 100,000, a $40,000 pump when you had an M2 pump this large. So that's the magnitude we're talking about here, guys. And it hasn't ended. It hasn't topped yet. We don't know. We don't know. Maybe it has topped. Maybe it will keep going. So that's why I'm saying, like, when we finally make it to this rally, this could be the rally that carries us to the blow off top. And I think that, and I'll be keeping my eye on this, but I think that I'll be taking profits on this particular rally, wherever it appears to end. Like, if it keeps going, fine, I'll follow it. But like, I'm not going to ignore this next rally. I think we've gone far enough and long enough in Bitcoin land to begin legitimately taking some money, some chips off the table. I think it's okay to start doing that on the next rally, breaking the all-time highs for Bitcoin. You know, we got to be way above 109,000. We got to be 120,000 plus in the middle of this rally. And then I think it's okay to start taking profits. And I think that if the rally's as big as it looks, we're going to start seeing some of the top indicators signaling. Things like CBBI are probably going to start reaching the 90 threshold, the 90 plus level on the confidence score, and some of the other metrics like the Pi cycle top indicator. I think we're going to start seeing them start to indicate that we are in the red zone, you know, taking profits, overheated market, that kind of thing. Not to say that we can't have a final parabolic move later this year, you know, in November or October, but I don't feel safe waiting that long, to be honest. I think the market, I think that we're honestly already overdue for a crash. I really do. You know, based on all the metrics I looked at, I haven't covered that in a long time, but the inverted yield curve, the federal funds rate raising and lowering, the increase in unemployment, I think we're still in that cycle. And from what I can tell, it looks like we're overdue. But, you know, a couple of months of being overdue can be an eternity for a euphoric bull run in Bitcoin. And I would hate to miss that, especially when the M2 is staring me right in the face, slapping me, telling me, you know what, hey guy, money's coming, you know, you sell, you miss out on this. I sure hope we're right. I'll leave you with that. Have a great day, guys. Talk to you again soon.